Okay, this is bad, but a quick note, expiring coupon code tonight, expected to be the highest price increase yet over at meetkevin.com for the courses on building your wealth. The reason for that, we've got big changes coming for November, and you're going to want to get in before. And get all my trade alerts for reallocations that I might be making here soon. I wanted to flip bullish today. I wanted some good data, but boy, we did not get that. And look at some more of these details here. First of all, the number of permanent job losers up on the not seasonally adjusted basis here, and on the seasonally adjusted basis. This is really something that we want to pay attention to, because this is how you end up getting a weaker economy. But if you look at the not seasonally adjusted level, we're up 151,000 permanent job losers on the not seasonally adjusted. On the seasonally adjusted level, we are up 214,000 on permanent job losers, which is not great. You also have this on temporary layoff level going down. In other words, fewer people are on temporary layoffs, and more people, almost 200,000 more on the not seasonally adjusted, and over 200,000 more on the seasonally adjusted are not on temporary layoff. These are just overall bad numbers. The more I go through the details, the more nervous I get. The number of full-time workers is down by over 200,000 in this survey, which isn't great. Number of full-time workers is down 200,000 based on this survey. Again, the more you go through these numbers, the worse it looks. You look at the government data here. Government data grew on the not seasonally adjusted level, and on the seasonally adjusted level, it shrunk. Remember, this is where last month we had this massive surge of 785,000 workers. That's right here. Remember this table Alpha 8? I kept talking about that one like over and over and over again. I'm like, this is a crazy jump, 785,000. It's going to get revised down. And guess what? It started to get revised down. But frankly, it's not so much the government workers that I'm worried about. It's what's going on in the private sector that I'm worried about. Private sector here lost 200,000 on the not seasonally adjusted. Lost almost, what do we got, 100,000, 102,000 right here. Private sector losing so many jobs that frankly, if it were not for government hiring in this report, we would have had a negative jobs report. That's scary. I mean, think about this for a moment. We had healthcare workers up 52,000, government workers up 40,000, but we lost 46,000 in manufacturing, professional and business and temporary help. We lost 49,000. Average it all together. Private payrolls, so non-government payrolls, were negative. You had to have government jobs just to even get this terrible jobs report that we got of positive 12,000. Now, my nervousness is because we only did a nominal adjustment to that 785,000 government worker spike that came out of nowhere last month. You know, we maybe adjusted that to like 650,000 approximately. You probably still have a massive amount of government worker revisions coming. And keep in mind, these revisions, they're getting worse and worse. In August, we initially had a 152,000 labor report. And then they told us, oh, it actually got better than expected. So we went from like 42 or whatever, all the way to 159. People were like, oh, things are better. The economy's doing better than expected. No, it was either a lie or just bad data. And so what happened? The August payroll report went from 159 to 78,000. That's a very weak report. And that strong jobs report of September, which was propped up by those 785,000 jobs, would have also been negative had it not been for all those government jobs. 31,000 revision to the downside. The payroll report this time, headline, comes in at 12K versus 100K expected. And the only reason the unemployment rate held steady is because the participation rate fell. Fewer people in the labor force because people are giving up. They're leaving the labor force. It's so hard to get a job. Now, obviously, we had some seasonal or maybe non-seasonal effects here, like hurricanes, disaster, FEMA hiring, Boeing layoffs, and strikes. Who knows? The household survey tries to account for all of that. It tries to say, hey, if you're just on a temporary layoff, we'll still count you as employed. If you're going to go back to work after the hurricane, we'll still count you as employed. The household survey, though, came in at negative 368K. Again, where last month they tell us we're positive 430, now it's negative 368,000. So the data just straight sucks. Like, I wanted to go bullish today, but the data is bad. This isn't good. This is a sign of an economy that is truly deteriorating. Average work week is down an hour. Average hourly earnings at 0.4%. The response rate on the headline, the establishment survey, wasn't that great, 47.4%, lowest since 1991, but it was normal for the household survey, which I prefer reading the household survey anyway because it doesn't have the impact of double counting employees like the payrolls report does, the establishment survey. But the establishment survey can be a little bit more stable, less volatile. But this is bad. In my opinion, like this is going to get us towards that trend of what I fear, which is in January, you just have recessionary payroll reports, where all of a sudden the Federal Reserve is having to do emergency cuts. I would not be surprised if this sort of data, which right now is only pricing in about a 25 basis point cut with a 98.5% chance, I wouldn't be surprised if we get another report that's this bad, which I think we will after that buffer of those household jobs and those government jobs continues to get revised down. When we get our November release, when we get our December release in January, when we get our January release in February, over the next 3 months, we're just going to keep seeing revisions down, numbers down. I don't actually see employment going up anytime soon. So that's where I expect employment will continue to go down, especially once government positions have been filled and seasonal layoffs happen in January. The Federal Reserve is going to be forced to do emergency cuts as soon as Q1 of next year to try to avoid a recession. Now, markets might try to rally on that because they're like, yay, the Fed will save us, the Fed will cut rates, and everything will be glorious again. They'll turn the money printer on. No, the Fed historically will act way too slow to a recession, and it'll take a lot longer to get to Federal Reserve capitulation, and then we'll be in a place of deflation with lower rates than we've ever seen before, lower wages than we've ever seen before. It'll be even harder to stimulate to create jobs because even if there's stimulus, people won't want to hire because they'll just use AI. I know you can't use AI for everything, but the recipe of the perfect storm is being created. It's in our frickin' face. The good news is we do have an expiring coupon code today, so check that out over at meetkevin.com. You can get in and get all my trade alerts for reallocations that I might be making here soon. Take a look at those over at meetkevin.com. Do keep in mind, we are expected to have one of the largest price increases after this expiration tonight at 11:59 p.m. We'll see you there. Thanks so much for watching. Goodbye and good luck.
Not advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.